Let's look at this. Okay, so multiple time frame analysis or top down analysis means you're analyzing starting from a very high time frame coming all the way down to a lower time frame. What that means is, for instance, in our case, we'll be moving from the 4 hours. We do our analysis on the 4 hours. We move further down to the 1 hour. Then finally, 15 minutes. That's where we have our entries from. So starting from the 4 hours here, you can see on my screen, right? Starting from that point, you can already tell that this was a downtrend. So you come up with entries. So this is a downtrend. So now, in case you are not able to see these points, since I've been doing this, I can see these points quickly, these ones. Then here there was like a forced breakout. Then there was that point, there is this point. In case you are not able to identify these levels, what I recommend or advise is to change these candles to a line chart. Now with a line chart, you'll be able to see the points quickly where the market had failed to push any further up. So you have that level, we have this other one here, we have this one smaller one here. Even this one can be counted. But remember, this trend line is not just a line, it's an area. So it means it covers just put another one, covers this entire area here. It's not just a line. But to avoid confusion or having a lot of things on your chart, it's best to just have one simple line like that. But in your mind, you should know that it's not just that specific line, but it's the area near this line like that. So then, after you change the candles to a line chart like this, you're able to see now these points clearly where the market was touching. Then also here down, we can see. Then the points where to put this line. You're just going to pick a point or a level where you're going to connect the most, touches. What I mean is, if I draw this circle here, you're able to see the line is touching those points. It's also touching these points here. It's also touching. It's also touching these points. It's also touching this point. Here there was a force breakout, a push up, force breakout, a push up, but we see this touch here. So that's how you can come up with the trend lines or the trading channels. They are called channels or just trend lines. That's how you can come up with them. Let me remove them. So why did I put those lines? They'll help you put the market in perspective. So if you just look at this market, you're not able to see clearly what's going on. But then once you introduce the trend lines, you just need to make sure that you put this line where it has the most touches. But remember, you have to ignore these smaller or minor retracement moves, like these ones, these smaller ones inside. You have to focus on the main ones that you can clearly see. afterwards, the next thing you want to do is, since this forms a channel, the lines are parallel to each other. That means you wouldn't even need to come and draw the other one. You just copy the same one, paste it, then bring it down. It will almost always be the right line like that. So put it like this. Then you can just now adjust it so that it has the most number of touches. Hope you understand what I mean by the most number of touches. You see, if I adjust it to this level, it will now have these touches here. You can see there's this one here, this other one, this, 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 and this. We're not going to count these two. Why? Because these two have gone past our line. So in short, they are invalidating that line. Then the other thing you're supposed to understand is the more you have, the more number of touches you have on these lines, these ones, the stronger the line. Okay. Okay. So the more the number of touches you have here, the stronger this line is, or this level shown by the line is. Once you're done with that, once you've identified on a higher time frame like the 4 hours what's going on, you now know that definitely this market is going. Let me just do this. You definitely know now. Let's say we're analyzing this part, the ones that I've just marked now. So I've noticed that the market generally is going down. Now, why is this important? So this is called, it's called a bias. So now what a bias is, a bias is simply what you believe to be true. So in our case, we believe that this market is going down, but you can also use a very, like, a bigger time frame, like let's say the monthly, weekly, and daily. They'll show you that maybe the overall trend is going down or up. This is just a retracement. But then for us, since we are only focused on trading on the 15 minutes, whatever the monthly and the weekly is showing, maybe we can use the daily, but the weekly and the month, whatever they are showing will be irrelevant to us because we're trading on a smaller time frame. But then if we were trading on the 4 hours, then the weekly and the daily would be very important to us. So now going back to my point, I was explaining on a bias. So a bias means you've decided that the market is going down because after doing your analysis, you've seen a downtrend. Hence, you believe that the market is going to go down. Now, since you believe that the market is going to go down, what do you expect it to be doing when you're trading? You only look for trades or setups that align with your bias. So you wait for setups that align with your bias. So in our case, since we know that this market is moving down, what I want to do now will be, I want to scale down to the 1 hour. Now, what the 1 hour is going to do, since I was on a relatively bigger time frame, this one is going to show me some levels that I previously didn't see on the 4 hours. So if we look at our trend line, if you want, you can maintain the line chart, or if you want, you can convert back to the candles. That's up to you. So the first thing I can see is, you see in this point here, the market failed to break those levels there. The next thing I can see is, you've seen this point here. That was like the lowest point the market had gone. If I push this, that other side. So then someone can ask, how am I able to find these levels that I've just drawn now? So the easiest way to find those levels is, remember, if a market is going down, let me see if I can have what this can do. Okay, yeah, okay, use this. Okay, so let me just. Okay, so you just go where it's plain so that you can see exactly what I mean. So if a market is going down, right? Generally, we have this. They need to push a little bit up. They need to come down again. It will push a little bit up. Then it will go down. Push a little bit up. Then it will go down. It will push a little bit up. Continues like that. In that manner. Now, if you see a downtrend, the levels that you should be focused on should be these levels here, the lower lows, these ones. If you don't remember what lower lows are, you go back to the textbook on trend lines and market structure, you'll find what lower lows are. So you focus on, anyways, it's fine. You focus on only these levels. Why? Because that's the lowest point the market had gone before it started moving up. Which means, if you remember our lesson on support and resistance, if you remember, if you connect that concept with what's going on here, you realize that always the lowest point that the market goes before going up is a point where it will go back and retest. In short, after this smaller move finishes, then we come back to this impulsive move. The market would want to come retest this level again, this level here. Then after it retests that level, it will push back down again. Right? So whenever you see a downtrend, the only things that you're supposed to be focused on are the lower lows, these ones. Wherever you just see a lower low, just put your triangle there, then extend it to the right. I can see another one there, like that. So hope this makes sense. So now we can erase this and go back to this chart now. So you can see the only things that I'm doing right now, I'm just picking the lowest points that the market had gone, which is this one here, which covers also for this one. Then again, you have to pick the levels that are touching the trend line. That's another key thing. So this one, you can pick it if you want. You can say that's also another level. You can also pick that because it's very close to the trend line. But the better ones are like these ones here, where the market is definitely touching that trend line. Just do that. You can also pick another one, which is just here. So it's something like that. Somewhere here. So you can just readjust these to suit that level there. Yeah, then the list goes on and on. But the main thing here is you're supposed to get the idea of how how I am able to come up with these levels here. Once you understand that, you now just go back to the 15 minutes time frame. Now what you're going to do here, you're going to go back to your candles. Once you go back, what you want to do is, this is exactly what you want to do. Now you want to be zooming in. You want to be zooming in. Yeah, so you can readjust these so that they cover the perfect point. So now what you want to do is, you want to zoom in, right? Since already you know your bias, you know that the market generally is going down because we've seen that on the 4 hours. On the 1 hour, we've been able to come up with the key levels, these green ones. So like for instance, I know for a fact that that's a key level. Then what I want to do is, I just want to wait for the market to reach this level here. Once it reaches that level, what's the thing I'm going to be waiting for? Now we go back to the lessons on candlestick patterns. Those candlestick patterns, the ones that represent a market going down, either it being an engulfing candle, if you still remember momentum candles, we have morning and evening stars, tweezer tops, those types of candles. Those are the ones I'm going to be waiting for to be formed, where I've circled there. Once I see those candles are formed, there's nothing like hesitating. I'm just going to enter immediately at this level. Okay, like in this case, let me remove this. What's this candlestick pattern that you can see? So the first thing we see is we have these two white candles. These are big momentum candles, showing that there's strong momentum going upwards. But what are the next candles that we see? So we see candles more like dojis or hammers, if you like. Those show instant shift in momentum, meaning we had come with all these big candles here pushing the market very fast up. All of a sudden, we're seeing these smaller candles. Those are the first indicators that the market is most likely going to reverse. Then after that, we see a bearish candle. After the bearish candle, what do we see? We see a shooting star. Now this shooting star, if you go back to the lesson on candlestick patterns, you notice that shooting star represents momentum going downwards because there's some push going up by the buyers, then a strong rejection by sellers. So all these are telling you the same thing. The next candle is also bearish, which tells you that the market is going down. So you don't even need all these confirmations. Once you just see a pattern that you're able to identify, like in this case, I've seen that shooting star, I enter from there. I reduce my stop loss to the lowest point, not lowest point, I meant highest point the market had gone, that level. I just put it slightly above that. Then what is my profit target going to be? My profit target is going to be the lowest point the market had gone on this other side. So the lowest point on this other side is right around here. So then I'm going to drag this all the way down to that level. So that's my profit target. So this has a risk to reward of 12. That means whatever amount you're risking, multiply it by 12 gives you the amount of money you would have made on this trade. So is that okay? Does that make sense? Or we look at another example?
Yeah, to
In my
me,
I'm waiting.
in my case, I would request for another example.
Another example. Douglas, you're fine?
yeah, I'm cool.
All right.
Where, for example, where you said that if you see like here where the market has reached the highest point,
This one, yes.
and after the highest point, you start seeing some
Candlestick
candlesticks.
patterns, yes, here.
Uh, So said, what happens? What do you do here after observing that?
You just enter the trade, you sell. After you get the candlestick
Or you say,
confirmation,
okay,
after you get the candlestick confirmation that you are waiting for, you sell, because overall the market is going downwards.
so maybe as you are like trading, you need to have unexpected
Yes, you
kind
need to
of
have a
candle.
bias. Yes, that's what I was saying. You need to have a
Oh,
bias. That's what a bias is. Like
oh,
you have a prediction based on market
oh,
structure. Yes, that's why the
okay, okay, I
lesson
see.
on uptrends and downtrends is vital.
Yes, yes,
Okay,
yes.
so
Uh-huh.
let's go back to the 4 hours. I'll remove everything so that we just start afresh. So overall, what's the market doing? It's going down, right? We can agree that this is a downtrend. So
Yes.
once we're able to identify that, that's why the lesson on trend lines, on trending on market structure, per se, is very important, because once you know market structure, you'll be able to identify the type of market that you are in. So in this case, we are able to identify that this is a downtrend. How? Because in a downtrend, we know that in a downtrend, the market always makes it has this up, that, pushed up, pushed back down, pushes up, like that. So we know that in a downtrend, the market will always be moving, forming lower lows and lower highs, like that. But then in the real market, it's not always going to be the same. As you remember the examples we did in those books. Those ones are meant to help you understand. But in the real market, it's not always going to be like precise, like the way it's portrayed in the book that we are using. So there'll always be some slight differences. Like in this case, you can see the market almost pushed here, a little bit
Mm-hmm.
higher than this level here. But we're still not going to consider this as in a change of structure. Or we're not going to use this and say, since the market has made the higher high, the market direction has changed and it has started going up. No. We're still going to maintain that this is a downtrend. The only time we're going to change our bias that this is an uptrend is when, if I was to draw something, is if the market breaks above this, comes back for a retest, and pushes higher than the previous, high, this one. There we'll be able to see the market has changed direction. So now, if we are to continue, we've identified that this is a downtrend. When you just identify
Yes.
the trend, that's called a bias.
Mm-hmm.
It's called a bias. A bias is just simply you saying, I think this market is going up. You don't even actually need to think, because just using market structure, you're able to tell if the market is going up or down, or it's just within a range. So once you are able to do that, that's the first step. It's called a bias. Now, the next thing you want to do is put the market in perspective. Putting the market in perspective just means you want to zoom out a little bit like this. Then you want to change the candles to a line chart. Once you change it to a line chart, what you want to do is you want to get the highest points the market has gone either on this upward side, on this side, and you also want to do the same for the bottom part. You want to just get the points which are furthest from the market, but those points should be sufficient enough. Previously, I had